Hi, and welcome back to the Food Fund. In this video we will be analyzing if Beyond Meat stock is a buy. Beyond Meat, stock ticker symbol BYND, is just one of many companies we explore on this channel. The Food Fund is focused on all things related to investing in food, beverage, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. We have a lot of goodness to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Beyond Meat. Beyond Meat was founded in 2009 in El Segundo, California by Ethan Brown, a vegan activist who wanted to create a more sustainable and ethical way to eat meat. Brown's vision was to create a plant-based meat substitute that would taste and feel like real meat, but without the environmental and ethical costs. In 2016, Beyond Meat launched its first product, the Beyond Burger, sold in over 85,000 retail locations worldwide. In addition to the Beyond Burger, Beyond Meat also produces a variety of other plant-based meat substitutes, including the Beyond Sausage, the Beyond Meatballs, and the Beyond Beef Crumbles. Beyond Meat's products are made from a variety of plant-based ingredients, including pea protein, mung bean protein, and coconut oil. Now let's look at the price action. Starting with the 1-year chart, we see that Beyond Meat had a CAGR of about -51%. Zooming out to the 5-year chart, we see that Beyond Meat had a CAGR of -39%. Beyond Meat share price has fallen dramatically this year. If we perform a backtest comparison of investing $10,000 in Beyond Meat versus the S&P 500, we find some unsurprising results. In that comparison with the S&P 500, $10,000 invested in Beyond Meat would have generated just $790 or a -48.4% CAGR versus $13,790 or an 8.7% CAGR if invested in the S&P 500. This demonstrates ridiculous underperformance for Beyond Meat. A Beyond Meat investment would have been much more volatile as well, with an 80% standard deviation versus 20% for the S&P 500. Although the best year performance of Beyond Meat beat the S&P 500, the worst year performance of Beyond Meat was much worse than the S&P 500. Beyond Meat max drawdown of 97% was just really bad and nearly 4 times worse than the 24% drawdown of the S&P 500. And surprisingly, Beyond Meat underperforms the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. Let's take a look at the fundamentals to find out more. Gross margin is -1%. Ouch. Revenue has compounded at around 34% over the past 5 years and was $350 million most recently. However, we can clearly see that the revenue peaked in 2021 and is now down below 2020 levels. If there is one thing that growth companies have to do, it is grow. Looking at cash flow, we see a -30% CAGR over the last 5 years for operating cash flow, while capex has over tripled during this time. As a result, free cash flow has fallen at a -21% CAGR. The good news is that capex started declining in 2022, with operating cash flow improving in 2023, resulting in less free cash flow burn from 2022 onwards. This improving trend might continue, but I am not hopeful. Weighted average shares outstanding have skyrocketed over the last 5 years, going from 6.3 million shares in 2018 to 64.1 million shares most recently. Beyond Meat has drastically diluted shareholders. Most of this occurred with the IPO. Since then, shareholder dilution has slowed tremendously. However, I expect a dilution event soon. More on that later. Now let's view return on invested capital. Return on invested capital has worsened from 4.5% in 2019 to -37.6% in 2023. This is not good. Like really bad. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 87 days in 2018 to 186 days most recently, Beyond Meat has gotten less and less efficient as time has gone on. There is no positive way to spin this. Beyond Meat is failing in every assessment category. Now, let's look at Beyond Meat's debt. The net debt to EBITDA has worsened over the past 5 years and is currently -5 since the company isn't profitable. This negative value means that Beyond Meat has more debt than cash. This is a very unfavorable position for a company to be in. The fundamentals of Beyond Meat are not good, and that is putting it mildly. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Beyond Meat. It is a food company with a gross margin of -1%. Don't even get me started on negative gross margins. The 5-year revenue per share CAGR is -18% and the 5-year free cash flow per share CAGR is 28%. Please note that even though free cash flow per share increased, it went from a very negative number to a less negative number. These are horrible results, but let's trudge on. A return on invested capital of -38% is really bad and means that Beyond Meat is losing 38 cents for every dollar invested in the company at this point. Next, the cash conversion cycle of 186 days is an all-time high, meaning it is the worst value in the company's history. Concerning debt, a net debt to EBITDA of -5 means that Beyond Meat has a lot of debt and isn't profitable. So from a fundamental standpoint, Beyond Meat looks perilous. I used a thesaurus to come up with that word. Perilous might be the single best way to describe the company. Now let's switch our attention over to valuation. Given that Beyond Meat isn't profitable, we cannot calculate its value relative to the S&P 500. Likewise, the price to earnings growth, or PEG ratio, is not calculated for this company due to its unprofitability. Now let's jump to the recent earnings report to see how Ethan Brown spoke of the past quarter. Though we are encouraged by pockets of growth, particularly in the EU where we saw double-digit gains in net revenues on a year-over-year basis, we are disappointed by our overall results as we continue to experience worsening sector, specific and broader consumer headwinds. As we shared last week, we are conducting a review of our global operations for purposes of further and significantly reducing our operating expense base as we seek to accelerate our transition to a sustainable and, ultimately, profitable business. And while we expect current headwinds to persist in the coming quarters, we have confidence in the long-term trajectory of our business, its central relevance to the intensifying health, climate and natural resource challenges facing our global community, and our ability to emerge as a stronger, leaner organization as a result of the decisive measures we are undertaking to fit the current macroeconomic reality and business environment. Wow. Ethan, you are disappointed? Imagine how the shareholders feel. Disappointed is an understatement. While Beyond Meat is facing unprecedented macroeconomic headwinds, management has compounded their challenges by making horrible decisions. The delay in cutting operating expenses doomed the company, with $218 million in cash while burning $151 million over the last 12 months. Beyond Meat looks to have just shy of 18 months of operating runway left. They will need to issue new shares to raise money or take on more debt. Both options are extremely negative for the company. I believe the most likely way out for Beyond Meat is to be acquired, either by a large well-capitalized food company or by way of a leverage buyout via private equity. Beyond Meat was an interesting company. The experiment has shown that consumers are open to meat alternatives when the taste and texture are superb. However, those same consumers are extremely price sensitive, necessitating that the company either acquire new price agnostic customers or drastically reduce costs. Either way, Beyond Meat is just too challenging for me to be long. Conversely, Beyond Meat has fallen by a tremendous amount this year and is susceptible to short squeezes, so I will probably not be shorting it either. I just want to be as far away from this as possible. For these reasons I will pass on adding it to the watch list. Many thanks for watching. What do you think about Beyond Meat and would you short it? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.